The data-dependent Federal Reserve is taking note of the incoming economic reports. The central bank began a two-day policy meeting today. It will release its statement tomorrow. But as Steve Leisman reports, many expect the Fed will wait a bit more before raising interest rates.
A slowdown in hiring, weaker overall economic growth. They've combined to convince Wall Street the Fed won't hike rates at this week's meeting, and maybe not even this year. The CNBC Fed survey finds that the median of the 41 respondents, who include economists, analysts, and fund managers, see the Fed hiking in December. That's 3 months later than the last survey.
My guess is the reason the Fed won't raise rates this year is the job market's decelerating. I expect job growth to remain on the relatively soft side through the rest of this year. And at the same time, I don't see much inflation pressures developing.
But the group is split. About half see a hike this year, the other half next year, or even 2017.
If they didn't find reason to do it in September when they had this great opportunity to do so, I don't see how they're going to rationalize doing it tomorrow or even in December, because not much is going to change.
The weak economic data has made Wall Street more worried about recession. The chance of a downturn in the next 12 months rose for the fourth time in a row. The measure is the highest it's been in 2 years, since the nation last struggled with a debate over a government shutdown.
There is a rising chance of recession, but the base case still is an economy that's limping along at roughly a 2% pace. But the second half of this year, growth will probably be a bit under that, and that's the reason why the Fed's not going.
All the on-again, off-again talk of a rate hike has many on Wall Street criticizing the new Fed chair. The survey shows Janet Yellen gets an overall grade of just C+, a full grade below her mark 6 months ago. For Nightly Business Report, I'm Steve Leisman.